All right, I had originally thought we would chat about some marketing tools that we have at the company called Total Expert. But after what happened on Friday and over the weekend, I thought, oh, wait a minute, we got a more important topic to chat about a little bit because you may get some inquiries about it and people are going to be wondering. And that has to do with, is anybody familiar with what happened with Silicon Valley Bank on Friday?
I know a bailout did not happen.
Or what happened to Signature Bank over the weekend out of New York? Nobody. You know what happened. Okay, so here's what I want to talk about a little bit. So because it's news, and this is actual news. So Silicon Valley Bank was the 16th largest bank in the US, and it got taken over by the feds on Friday morning. And I'm going to explain the impact of that and why it happened. Over the weekend, Signature Bank out of New York got taken over. And both of those banks were run by their respective states. There's two different ways that banking operations work, excluding credit unions. But your typical banks, they're either regulated by the Office of the Comptroller of the Currency, called the OCC, or they're regulated by the State Banking and Finance Commission. In both of these cases, the banks were regulated by the Banking Commission in their respective states. So, and all that means is that the regulator that monitors them, who they're going to be reporting to. Now, the interesting thing about the bank that went under on Friday, as I said, it was the 16th largest bank in the U.S. It was the second largest bank failure since 2008. And the first thing that people start wondering about is, wait a minute once, we're having a $200 billion bank that's been around since 1986 when it started that now collapsed. What's that? Are we going to have more and more and more of this? And then over the weekend, Signature Bank out of New York, which is about half the size of Silicon Valley Bank, then they went under. So is that systemic? Well, I want to just ease everybody's fears. First of all, the primary reason that these two institutions ran into problems has a great deal to do with the nature of their focus. And the nature of the focus for Silicon Valley Bank were startup tech companies. That was the primary function of their business. And we'll talk about that in a moment. Signature Bank, the primary focus for them is cryptocurrency. That represented somewhere just shy of a third of all their business. Anybody know what's happened to cryptocurrency in the last 3 months? That has gone away, or not away, but tanked. So they ran into some problems, and I'll explain all that in a minute. Just a little bit of history. Some of you, most of you probably don't know this about me. I started a bank. In 2001, we opened a bank up on Windward Parkway. That was before Windward Parkway even had a name, almost. And I tell you that so that you know that I do know a little bit about what's going on with banks, what to look for. Now we got real lucky. I wish I could say I had a ton of foresight, but in 2005 we sold our bank. We opened in 01, sold it in 05. We primarily did that because myself and the rest of the board, we didn't want to raise capital again. We were growing, and in order for us to maintain what the regulators require that you've got to have in capital, we would have, if we're going to keep growing, we have to add more capital, which meant we would have to go out and raise we'd have to do another stock offering. We had already done 2 stock offerings, successful, but we said we don't want to do it anymore, so we sold the bank. Now, anybody know what happened in 2007 and 8 and 9 with banking? Every local community bank that opened around the time that we did collapsed, except us, because we sold. I wish I could say I had all that foresight. It really wasn't it. We just got lucky. Sometimes lucky's better than good. So let's talk about what happened here. Silicon Valley Bank did not originally start out as being a big startup thing. It actually initiated because there were a couple guys that were bankers, successful bankers. They were playing poker, true story, and they went ahead and decided they should start a bank. And then they started doing things a little bit differently and blah, 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 and they got into the tech thing. And they grew wildly when tech was moving up in the 90s, and then the collapse came and they lost half their value and they started. But anyway, what they've done is they went ahead and put a big, big focus on being involved with startup tech companies. And they just grew the bank gigantically to, like I say, 16th largest bank in the country, about $208 billion in assets. Does anybody know what assets are in a bank? I thought so. Most people.
Deposits?
No, thank you for saying it though, Casey. I was hoping somebody would say that. Assets are loans. Deposits are liabilities. And why would it be? Well, you think about this, okay? If I'm holding your money, you give me $100. I'm holding your money. Is that my money or is it your money? It's your money, which means I owe you $100. That means it's a liability to me, right? Yeah. That's what happens in banks. So when you loan money from a bank, if I loan you money, you owe me. Yeah. That's an asset. So the bank Silicon Valley Bank had over $200 million in assets. Means that's the amount of money that they had loaned out. They had, let's see, what did I write down? They had about $175 billion in deposits. Now here's what happens. So they had this huge influx of deposits coming in from these startup tech companies. And a lot of that came in between 1999 and 2021. And why? Because venture capitalists were pouring money into these startup tech companies. And the primary place startup tech companies started putting money is in Silicon Valley Bank. That was their focus. Well, end of 2021 rolls around and inflation starts creeping up a little bit, and the venture capitalist money started subsiding. And it went way, way down. Well, if you've got a startup company and you can't get venture capital, what are you going to do? You're going to go get all that money that they gave you before, and you're going to start spending it so that you can keep your startup company going. So what happened at Silicon Valley Bank is they started having to pay out the deposits that they had. They had to start paying money because people were coming in and saying, I deposited X amount, I need some of that now so I keep my business going. And the deposits started going pretty fast. Now, just because they had $175 billion of deposits doesn't mean they actually had $175 billion of cash, because they loaned the money. So in 2008, the regulators made a bunch of changes when we had all the banking crash, is they said, now you're going to have to put in various types of safety features to help in the event that there's call it a run on the bank, where they start coming out to get money. Well, there's various ways to do that. And typically, one of the safest ways to do it is for a bank to buy U.S. Treasuries. If they buy U.S. Treasuries, then the U.S. Treasuries, that becomes their hedge, if you will, against all the deposits that they have. Makes good sense. It's always been a safe place to go. Silicon Valley Bank put a ton of money into the Treasuries, tons of it. So now, what's happened? We all know what happened. Fed started doing what? Raising rates. As the Fed is raising rates, the yield on those deposits started becoming of less and less and less value. That's called an unrealized loss. Unrealized because as long as you don't sell the bond, it's just a paper loss. But as soon as you sell that bond, if you didn't make any money, you had to take the loss. Well, in the last couple of months, they're getting a run on the bank. The bank's getting, all these people want their money, want their money, want their money, want their money, want their money. So what the bank had to do was start selling these bonds. Well, now all of a sudden, what was a paper loss is now a real loss. And when you're in the banking business, the regulators are always looking at where you stand. And unfortunately, in the case of Silicon Valley Bank, they didn't have enough capital to sustain everything that they had in deposits. They didn't have it anymore. It went away because the yield on that paper loss is now real loss. And it was over $2 billion lost just like that. And that's why the regulators went in on Friday and took it over, put it in the hands of the FDIC, which protects all of us on our deposits. And the FDIC immediately came out and said, you're going to be fine. All your deposits are secure. Why? Because we're the federal government. We'll make sure they're all okay. So, what does that mean for the local bank down the street? Absolutely nothing. Because the local bank down the street doesn't have a ton of their money sitting with, some small startup company. They're diversified. And when you own a bank, that's one of the things that the regulators want is diversity. Signature Bank, a very similar situation occurred, a little different but similar in New York, and that had to do with cryptocurrency. They had so much invested in the cryptocurrency side of things, as that has collapsed, their capital requirements just became overwhelming. And so over the weekend, the state of New York came in and said, you can't operate anymore. And they've now set up a new company that is headed up by the CEO of Fifth Third Bank Corp., the holding company. And they're going to run it. And again, FDIC has said, everybody is fine. Now, why is this not like what happened in 2008? Well, first of all, 2008, we not only had a banking crisis, but we had a housing crisis. You've all seen the charts. The inventory in 2008 was like this. With new home construction, homes on the market, inventory was here. And many of the banks, I mentioned the smaller banks that started when I did, they had way over-leveraged themselves on real estate. Way over-leveraged. And so when the market started collapsing, guess what happened to them? And that's not the case today. Inventory is down here. And banks, you know how hard it is for builders to get loans today?
Yes.
Yeah, builders can't, it's tough to get a loan. In 2000, 2001, 2, 3, and 4, if you said, I am Greg Janicki and I am a builder, the banks would come rushing to you to loan you money. Today, not so much. Today, you have to prove that you've got a good business plan and that they are in fact going to, if they loan you any money, you're going to have to show. And before they loan you the second one and the third one and the fourth one, you better make sure that you've done a good job on making sure everything was done on the first one or second one or third one before they give you 4, 5, and 6. So the good news is this has got very little to do with any of our banks that we do business with. Our bank put out a thing this morning to all the employees saying, guys, everything's fine. We're not even, there's capital ratios you have to meet. Our capital ratio is more than 50% of what the regulators want, so we're in great shape, and most of your banks are in that kind of condition. Unless, of course, and I think there might be some other institutions around the country that are probably sweating today a little bit because they're a little bit too focused on one piece of business as opposed to like the regulators want. They want you to be a little bit spread out. They don't want you to be everything to everybody. They don't want that. But they also want you to not be so tied to startup venture capitalists because that could create a problem, which is what happened here. So I think we're all okay. Now, what impact does that have on you and I? First impact is that it's all over the news. So if you haven't seen it yet, you will, and be assured your clients your customers are going to see this information. And one of the things somebody's going to ask you, I promise you, oh my gosh, are we back in 2008 all over again? No, we're not. And the talking point, without remembering all this garbage I went over on assets and deposits and all that crap, all you got to remember is the fact that those two institutions were highly focused on one industry. One, startup tech companies. The other one, cryptocurrency. So no, this is not 2008 when everything had to do with what was going on in the housing market and land and real estate investment. That's not the case today. Real estate investment is as strong as it's ever been. So when they ask you, tell them, no fears, no fears. We're not going back into that. We're all good. That's your talking point because that'll come up. So what's the other thing that you might want to know about? This morning, you've heard me say many times, the direction of the 10-year Treasury note, the direction of 10-year Treasury note is where long-term interest rates follow. I mean, long-term, the yield on the 10-year this morning dropped drastically. It went down a little bit on Friday. It dropped drastically this morning. So I think at some point today, we're probably going to see some pretty nice interest rates. Maybe back to where we were at about a month and a half ago. Big drop. We went from 4% last week, Thursday, at the yield. This morning, we actually hit 3.49, which is a huge drop. I mean, over a 50 basis point drop in a day. I mean, in 3 days. That's huge. 3.49 we dropped to. So, I think we're going to see an interest rate drop. Now, do I think that's going to be sustained? Probably not in the near, but as the rest of the economic news comes out this week and next week and the week after, I think you're going to continue to see interest rates soften, just like I've been saying for months. Now, granted, we had that blip for about 2.5, 3 weeks because all the February numbers that came out reporting January information scared the crud out of the markets because they said that all the Fed work wasn't working, which is a bunch of garbage. The Fed stuff's working beautifully, and all the back data is supporting everything that's happened. So we're going to be fine. Interest rates are going to continue to soften, and I still stick with what I said before. You've heard me say it now for probably 2 months. May 10th. I think May 10th is going to be a really good time for us in the long-term interest rate market because we're going to continue to see the market moving in the right direction for interest rates. Okay?
Why May 10th?
Because that's going to be May 10th is going to be one of the dates where they announce CPI. And on that particular day, they look at two things, month over month and year over year. The year over year numbers are going to have a drastic drop on May 10th. Drastic drop. Why? Only because the April numbers from last year were so high. And we've been coming down every month. So when they look at the year over year numbers from April, May 10th will announce April numbers. When they look at that, they're going to see this huge drop in year over year. And when they look at all the other factors, shelter cost and everything else that's come down, it's just going to, that's why May 10th is going to be the day. That's when they announce CPI for April. All right, now I've dumped a whole bunch of information. A lot of it is just more for you to just know about, but not for you to go into unless you want to read about it and study about it, and you don't need to do all that. But I think, as you've heard me say many times, one of the best things you and I can do is be more informed than the people we serve every day. If we can demonstrate that we are more informed than the people we serve every day, then we become their trusted advisor. And that's really all that we want to do. So if I were you, I mean, I wouldn't go run out there and start trying to put out this in your Instagram or all that. I think it's a little bit too complicated for that. But I think what you want to be able to do is if you're in conversation, somebody says something, you can always just, like I always say, ask them the question. Well, where did you hear that? What do you know about that? You heard Silicon Valley Bank? Tell me what you know about that. Well, I don't know. It just scares me because it could be 2008 all over again. Why do you think that? And they'll come back, well, I really don't know. Well, can I give you just a little bit of information? Silicon Valley Bank was started in 1984. The very fact that, or 1986, the very fact that you know that and they don't, puts you a step ahead of them. And then you can say to them, do you know what business they were in? Well, banking. No, but I know that. But you know what businesses they primarily served? They served start-up tech companies. Startup tech companies. And when startup tech companies need cash, they started taking their deposits out, and that's what created the problem. So no, they're the largest, they were the largest bank serving startup tech companies. And then they got into another business, one other side note. They got into, they helped the wineries in the state of Washington, and they started loaning money to the wineries in the state of Washington. Just fabulous. I mean, I'm just thinking, what are you people doing? You know, somebody was probably, more than likely,
There's no volatility.
somebody was a wine drinker and said, you know, we should go do that. Oh, you'd be amazed at how banking works. I mean, you know, we all think it's all sophisticated. And yes, it is for Bank of America, Chase, and these others, but a lot of the smaller banks, no, it's amazing what goes on over a lunch or a card game.
That's where you go get your builder loan, is the small.
Exactly, yeah. So I think that's what you want to be able to do, is just be a step ahead of your clients. If they ask the question, again, ask them a question. How did you hear about that? What do you know about that? Tell me. Well, I really don't know. Well, then can I offer some information? Sure. By the way, Signature Bank started in 2001, same time I opened my bank. Started in 2001. Again, piece of information your clients probably do not know anything about. And that date says, well, maybe I should listen to Claire just a little bit more. I mean, she knows the bank, one started in 86, one started 2001. She knows they were in this business. Oh, and Claire says everything's going to be okay. Okay, Claire, thank you. I feel better now. That's how this works. And that's what you want to do. All right? Before we break, any questions? Anybody? No? Perfect. Thank you. Appreciate it.